personally, business is extremely robust and have not seen any downturn in the businesses that are coming to me. When the seller realizes and wakes up in the middle of the night and goes, oh, I thought I was getting this, but now I have capital gains tax. Now I have the note he's asking me to hold. Now I have the broker's commission. And now I've got to leave $2 million in working capital.
Yeah.
What am I walking away with? I've been through this myself. So anything that I talk about, I've been there, done that. So I can share my experience with both the lending side as well as, you know, what it takes to acquire a business, because I've done that as well, and I do that, right? So I've been in the lending game for a long time, but I'll just cut to 10 years ago, you know, after a storied career in banking and owning my own corporate consulting firm for 13 years. I got the opportunity to work with a searcher who came out of Harvard and basically shared the search fund model with me. I was enamored by it and thought, wow, this is the greatest thing since sliced bread. And since that time, I really haven't done anything else. So for the past, let's say 10 years, I've strictly been doing search fund lending. I've closed $450 million in enterprise value since that time. So a number of deals for searchers. These are all self-funded deals. It doesn't work with the traditional search fund model, because in that case, you know, the searcher's got less of a share, doesn't want to corporately, you know, doesn't want to guarantee the loan, nor do the traditional investors. So with traditional search fund, SBA lending doesn't work. So I, you know, got the opportunity to do this loan. I decided I'd go back to school and become an expert in this space. And I went and became a certified mergers and acquisition advisor. It was tough for a guy to go back to school at my age, but I did it. To be transparent, okay. Then I went back to school and learned how to become a certified value analyst. So, you know, appraising businesses and just, you know, making sure that I have all the credentials to work with folks like you. For me, I've been very fortunate and very blessed that I have the luxury of getting up and coming to work because I want to, not because I have to. Probably like a lot of folks on this call, right?
Yes.
It's what we all strive for, financial independence. I tell everybody, I'm not going to lie, it's great when you can achieve it. And so that allows me to keep my focus really strong and make sure that what I say I'm going to do, I am going to do. And one of the things about working here, I'm a senior vice president at First Bank of the Lake. As a condition of my joining the bank, if you will, it was making sure that I had the autonomy as well as the team, as well as the say in doing the deals I do. So that's why you'll hear, oh, you know, if Bruce says he's going to do it, well, it's a self-fulfilled prophecy because I make the decisions. So I'm not going to tell you I'm going to do it and then not do it. It doesn't work that way. So that's really great because, you know, you can give to folks who are acquiring business the two things that they're looking for, which are certainty of close and speed. Right. So I've got my own underwriter, I've got my own closer, and my own legal team here. So it's really a terrific model, and it's absolutely designed with folks that are on this call with them in mind. Right. It's making sure that when we look at a deal, and I say to you, yeah, this is a deal that will pencil and a deal that we can get done, and it fits my parameters, and it's what I like. Then it happens. I greatly appreciate the Twitter followers. It's something that I guess I have to say now X, formerly Twitter, right? Yes. I can't say Twitter anymore. Elon Musk will come and noodle whip me.
Yeah, it is. It is definitely a great forum that allows a little bit more creativity and a little bit more storytelling. And so, from your perspective, having been in the space for a while and having seen a lot of deals, what are the trends that you're seeing, you know, after COVID, you know, and all the nonsense that happened during COVID?
It's been phenomenally robust. I've
Okay.
seen a great deal of deal flow. So, I thought, okay, 2019 was great. It wasn't sure what was going to happen. 2020 was better than 19. Okay, let's see what happens in 21. That was better than 20. 22 is better than 21, and 23 is going to be better than 22. So it's been what I call a snowball rolling downhill, because the more deals you get out there, the more deals that you tell people to do, the more that there's around the space. When you look at ETA, entrepreneurship through acquisition, the number of schools that are coming on board with that program. When I graduated, Jay, it was like, okay, go buy a house, get married, have kids, have a family. Now it's don't ever get married, and if you do, don't change your name, and don't buy a house, invest in a business, and become a multi-millionaire. I mean, the dynamics certainly, have changed, but from the activity that at least I see, people ask me all the time, hey, has the increase in interest rates affected, deal flow? Absolutely not.
Okay.
Zero. Let me just speak to that for 2 minutes so it resonates with the folks on the phone. Typically, I'm doing deals where EBITDA is $1 million plus, right? And so these are deals that today are trading around to 4 times, so of $4 million. So a typical structure is a searcher will put in 10%, $400,000. A seller will hold 10%, $400,000, and they're getting a $3.2 million loan. Well, on a $3.2 million loan, you've got payments of about, let's call it $44,000 a month. All right. So with a seller note, you may be at $500, $550 all in. If you need a little bit of salary, $100,000, $150,000, you still got $250,000 left over. A quarter a point, a half a point, 1% on that size loan, you're talking about probably $25,000 a year. Well, the bet is that you buy these businesses not to keep them where they are or to make sure that they remain stagnant, but to grow them. That's the premise of it. It's like whether it's real estate or whether it's a building, you buy it because you have a plan in place to increase the revenue that it earns or increase the income that you get from the property, right? I mean, that's the idea. So if you're successful in doing that, you don't even see the increase. And I can tell you, when I joined First Bank of the Lake just about 4 years ago, interest rates, prime was 3.25% back then, right? So you had loans at, let's say, prime plus 2, so you're 5.25%. Today it's at 10.25%. So you're talking about five whole basis, an increase of 5% in the interest rate. And I've spoken with a number of my clients, and my clients like, it doesn't even move the needle, Bruce. It's not even impactful.
Nice.
Just because the idea is that you're going to take these businesses from where you buy them to grow them, make them your own, increase the EBITDA, and then eventually sell it for a higher multiple than what you bought it for. So I personally, business is extremely robust and have not seen, any downturn in the businesses that are coming to me. And to be transparent, I would tell you that 95% of my business comes from X, formerly Twitter.
Nice. That's awesome. And in terms of like the deals that you're seeing right now that are in the deal flow that are pencil out, what is the anatomy of a deal that pencils out? And I'm assuming it's something similar to what you just said, but where do they look like today? And then what do they look like when they don't pencil out today?
So this past Saturday, I had a really, I think meaningful thread or post.
Yeah, we read it.
On a deal that didn't pencil out, and why, right? Deals that, you're buying, because a lot of times I'll see people go, I'm looking to buy a business, with $500,000 in EBITDA. Today, that's going to be a very difficult deal to pencil out, depending upon what your salary requirements are, right? Because if you're buying at something at a 4 multiple, and in those deals, and I constantly talk about this, is in those size transactions, working capital is not included. So you got working capital, you have deal fees. If it's in light manufacturing, you maybe have CapEx, or if it's tow truck company, you've got to put a lot of money into maybe new equipment if the equipment isn't good that you're buying. And then when you factor in the loan payments, maybe a seller note, your salary, moving interest rates, working out all those size deal, it's very difficult to pencil out. It truly is. So the deals that are $1 million plus are actually easier to pencil out than deals 500,000 or less.
That makes sense. And in terms of like, I know you mentioned, I read that thread and you mentioned a lot of elements in there. So let's start from, working capital, for example. So where you're thinking around working capital, how do you calculate it for you, from your standpoint, what pencils out and how do you think through it?
Yeah.
As a lender.
Yeah, I'll tell you as a lender and as a business owner, right? I mean, working capital, it's okay. You go to the car dealership, you buy the car and they go, what do you mean you want the engine? Right? Yeah. Well, how am I going to get it off the lot? Right? Like, so. Right. Yeah. That's working capital, right? And so what I always, and I have this conversation with every one of my clients, we go deep dive. Because you can't be wrong with this number, because it literally could put you out of business. It's interesting, and I'll just share a quick story with you. I had a client many years ago. He was buying a business in New Mexico, and the business did specialty sound equipment. Okay, you buy a luxury house and you have a sound room, right? So the speakers and the movie screen and all the entertainment, and then they put the wireless, and all that kind of thing. He bought this business and he said, oh, it needs a little bit of working capital, not much. But about 3 weeks later, he called me up scrambling. And I said, what's the matter? And he said, when I bought the business, I didn't consider the trade lines with the vendors, like Sony and, some of the other equipment vendors that are out there. LG and all, he says, and I'm not getting trade lines. They gave the old owner, he had $100,000 lines of credits with his vendors because they knew him. He'd been doing business with them for 15 years. I'm the new guy. I step in. They don't know me from Adam.
Correct.
I made a huge mistake. You got to help me. How much in credit card debt do you have available? I mean, literally, like, how are you going to fix that? Because it's those kind of things, because that was working capital, right? Now he didn't have that. He didn't have the vendor lines, which is a form of working capital, right? So when I get into a transaction and we look at working capital, Jay, it's taking that business, talking about the business, the conversion cycle, how they generate cash, how long it takes them to collect it, how much inventory is going to be left. Is it just the working capital to run the business, or is it working capital to buy the product? I mean, so I always, and the sellers know best. So what I always advise my buyers is have the conversation with the seller, and we call it in my world sub-zero gain. And I'll explain, I'll break that down. Sub-zero gain. Substituting the buyer for the seller, there should be zero gain in working capital when you sell the business and I buy it. So on Monday, Jay, we signed a contract. You're the seller, I'm the buyer. Tuesday, I now own the business. The working capital you needed on Monday should be the same that I need on Tuesday.
Correct.
Right? Sub-zero gain. And who knows that best but the seller? So you ask them, Mr. Seller, I'm going to be in your shoes on Tuesday. How much money do I need? And I had this conversation with somebody this morning. I said, you can relate it to personally. We all have personal living. We all get income somehow, some way, and we all have expenses somehow, some way. And everybody has a number that they feel comfortable leaving in their checking account.
Yes.
15,000, 25,000, 50,000, whatever you feel comfortable with. That's your working capital adequacy. It's the same for the business. It needs cash in there so that you can comfortably operate the business and not have that noose too tight around your neck, right? And so when we will calculate it here for sure.
So you do?
Oh, we sure do. So I had a client on Friday, true story. He calls me up, I don't know, maybe Maybe this will be the next War Story Saturday. I don't know. Maybe next week. This is a good one. By the way, I have no clue what I'm going to write from Saturday to Saturday.
Nice.
Sometimes I do it on a Friday night. It's all based on what happens during the week in conversations like this. So maybe I got to take a note. This is going to be it. So I have this conversation with this guy on Friday. Signed LOI, got his data room all set, calls me up, Bruce, I'm ready finally to submit. I said to him, okay, did you have a Q of E done? Quality of earnings. Yes, we did. Okay, what did it come back at? $2 million of working capital. I pull up his LOI. Your LOI shows $1,250,000. He says, I know. I said, 750 short there, Tiger. And he says, I know. He says, and I said, you either have to ask for it and it increases your deal by 750,000, or the seller's got to give it to you. Either way, you need it, right? He said, yes. He said, now I got to go back to the seller and I got to retrade. I didn't realize that I needed 2 million, not $1,250,000.
Yeah.
That's a big swing, right? That's a big number. And if you're not getting it from the seller, you got to borrow it. How does that change your debt service? Well, on 750,000, that's another almost $10,500 a month. It's another $120,000. If you're buying it on a 4 times turn, that's $500,000 in value differential just for the working capital.
Yeah.
That doesn't include deal fees on top of it, which now obviously your deal fees are higher. So I know it's probably, I belabored the point on working capital, but it's a very deep conversation that I have with my borrowers because you can't be wrong with that number. You just can't.
And we absolutely agree. And I mean, I had a situation just a few months ago with a couple that was selling a business that was doing $15 million in revenue, where I asked the couple at a lunch, what is the working capital? The husband thinks it's 300,000. The wife, it thinks it's $1 million, and it came out as at $1.5 million. And so how to have that conversation, how to negotiate that in a deal that's $17 million purchase price, and how to explain to them that working capital comes in, and how to calculate, work in progress, and how to, it's a little bit more complex that even the owners themselves don't understand sometimes. They don't know their own working capital. They think the cash in the bank is working capital, but that's not it. It's all of it. And they, and it's a very tricky conversation. So we always kind of belabor this.
And I'd love to share one other thought process behind it for the group.
Yeah.
What happens is if, let's just say in that example, it was 2 million and the seller thinks he's only leaving, $1,250,000. So now he's got his purchase price, right? And you ask him to hold a 10% note. And if there's a broker involved, capital gains tax, and now $750,000 less. That changes. Think about that, folks, from his perspective, how much he's going to walk away with cash. This is why I've seen so many deals blow up, because when the seller realizes and wakes up in the middle of the night and goes, oh, I thought I was getting this, but now I have capital gains tax. Now I have the note he's asking me to hold. Now I have the broker's commission, and now I've got to leave $2 million in working capital.
Yeah.
What am I walking away with?
Yeah.
Why would I do this deal? This is not a good deal. And trust me, I have seen deals blow up, and I've told people this deal is not going to get across the finish line. I can tell you because I've seen it. I've closed over 12. That's what I've closed, over 1,250 transactions. Think about all the deals that we got approved that we didn't close, right? Yeah. So I have a little bit of experience.
So how have you seen the successful acquirers navigate that conversation up front before? Because a lot of these conversations is because it gets anchored pre-LOI or during LOI, and then you have to go back and retrade afterwards. Yeah. What have you seen, like the the master acquirers, or how have you seen it done in a good way up front, where it flows and it ends up closing without any issues, hopefully?
Yeah, a lot of people just want to put in they want to get the deal.
Yeah.
Right. And so they just put in the LO, we're going to do an average working capital peg of the last 12 months, blah, 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 blah. Right.
Yeah, it's vague.
Right. Do they really understand? And to your point, and you said it, the sellers don't.
Right.
They see that verbiage. Remember, maybe they're a baby boomer. Maybe they're old. They're like me. And they haven't gone through an acquisition. They built a business despite themselves. It's successful. This is the first time that they exit. They don't understand what that means. To your point, Jay, guy says 300, wife says $1 million, it's $1,050,000. Imagine if the normal working capital average peg, and that seller was the guy, and he thinks it's 300,000. Now you hit him up with the $1,500,000. You tell me what happens with that deal.
Yeah. Blew up.
Yeah, blew up. It's exactly what happens. So how do you do it? When I do it and I sit down with sellers, I say to them, I'm not going to leave this to the purchase agreement or the stock purchase agreement, whatever the case may be, because I've seen too many deals blow up. We need to have the conversation, and we need to be on the same page now. And I'd rather do it now and lose the deal than 2 months after due diligence, time, money, everything, and lose the deal, right? So a lot of times what I am going to do personally is say, okay, Mr. Seller, I want to explain to you the number that I think this business needs to adequately run on a day-to-day basis. And I want to put that number in the LOI. And in my last deal, we did. And then 2 weeks before closing, the seller still came back and said, I don't want to leave you that much.
Yeah. But how do you come up with that number before doing due diligence? Or before?
Yeah. Okay. So here's what happens. I ask for balance sheets.
Okay.
A lot of times brokers want to give you the SIM and they want to give you the income statement. You can't figure it out with that. You got to ask for the balance sheets. So I ask for the balance sheets. And then I figure it out. I look at it. I'll look at the average days on hand. I'll look at the average days on inventory. I'll look at the cost of goods sold and see if any pegs. I'll look inside, the income statement to see, hey, if you're buying a business and all of a sudden that business is now going to be hit with huge increases in people's salaries or huge increases in rent, the seller is selling for a reason. That's a very big question for me. The 3 big questions. Mr. Seller, when's the last time you took a vacation? Where did you go and for how long? Those are 3 instrumental questions. Where did you go, for how long? Yeah, you have to ask those questions because maybe he knows something that you don't, and that's why he's selling the business. I always get very concerned. Yeah, the seller's 45 years old. He's had the business for 4 years and he's tired of making $1 million. No. I'm not falling for that. Next. No.
Yeah. So I heard you speak about, I saw the thread about talking about salary, and then you had like the 40% DTI. Can you walk us through that calculation?
Sure. Yeah, it's very easy. So banks, and listen, I'm going to be honest with you. As I was moving up in the banking industry and I was a salaried employee, wife, kids, and everything, I tried to move this formula and prayed that it didn't work. It works. It is the true number. So the way this works is you take your average burn rate, what you need per month to live. And let's just take a number of $5,000 just to make it easy. If you need $5,000, hey, Bruce, my mortgage and blah, 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 blah is $3,200. I've got, 2 lease payments. It's another $500 each. That's $4,200. I have credit card debt and I have some other stuff. It's $5,000 a month. for your main. I'm not talking about food, I'm not talking about all that. I'm talking about your main where you have payments. It's $5,000 a month. You take 5,000 times 12, obviously, is 60,000. Divide by 0.40, and that comes out to $150,000. So if I look and I see that your burn rate is $5,000 a month, I am going to automatically allocate in my calculations. I don't even have to do it. It's in our automatic calculations when we go to underwrite the deal. Pops in $150,000 required salary. So it's monthly burn rate times 12 divided by 0.40 equals X. That's how much a bank. And if you do it for yourself, you'll see that number is right on. It's absolutely spot on. I tried so many times. Do I really need that much money? Honey, can you stop spending? We can't afford this.
Now, how about you mentioned add backs. So your thought process on add backs.
Yeah. So look, I tell people this all the time. I'm not going to dispute SDE, solid discretionary add backs. That's cell phone. That's insurance. It's automobiles. It's meals and entertainments. It's, things that you use personally. But if you're the new owner of the business, that's the benefit of owning a business. I'm not disputing them, but I'm not going to give you any credit for those towards debt service because you're going to be using it for the same thing. You're going to have to pay your own insurance. You're going to have to pay your own cell phone bill. You're going to have a car. You have repair, maintenance, insurance, gas, blah, blah, blah. You are going to do meals and entertainment. I've been there, done that. I had my own business for 13 years. I did everything and anything that you're supposed to. And most small business people, where they get into trouble, and my dad was a perfect example, is they don't want to pay Social Security tax. So they record a low salary. Well, maybe you need a high salary. So maybe your taxes are even going to be more. Right? I mean, everybody's got different living expenses and living style. But I always tell borrowers this: pay in because you aren't going to get back when you need it. You're a small business owner and you think you're going to get Social Security, you don't put in, you ain't getting out. So that's just a reflection of it. So add backs, I'll give you just a couple of quick examples of add backs where we absolutely accepted it. Did a deal many, many years ago. The guy lived here in the Florida. I'm in Florida. He lived in Florida. He was an avid sports fan, and he got business this way. He had seasons tickets for like the seasons, like he had the Marlins for baseball, and he had the Heat for basketball, and he had the he didn't have the Panthers because that was the same time, and then football, and then the Miami Dolphins. So he had the Dolphins, the Heat, and the Marlins. Well, that's like $35,000 a year in season tickets. The new owner came back and said, those are expenses that I like sports, but I'm not doing that. Absolutely. That's an add back. We will allocate that $35,000 towards debt service, right? So those are add backs. Sometimes you see people have golf memberships. I've seen a lot of people where they'll have a plane. I've seen that a number of times, right? So the owner has a plane or he has a yacht.
Yeah.
And he's expensing through the business.
I would be worried about those season tickets because there might be like some customers that rely on those tickets to stay customers. And I remember like East West Bank when I was in California, I had Laker box, and that's all they did to get customers. And so I would be concerned if that buyer decides to cut that off because you might lose a couple big customers.
Yep.
Interesting. Okay. And in terms of like seller financing, so we do get lots of questions around seller financing. So what are your thought process? And I'll open it up because a lot of guys have questions around seller financing.
Sure.
What are your thoughts on seller financing?
Seller financing is interesting. I signed an LOI last week. We got to send in the deposit this week. And I went in and I said to the seller, Mr. Seller, I want you to hold a note, this amount of money. And he said, good, I'm glad you want me to, but I'm not. okay, all right. He says, I don't have to. And, if that's a big thing for you, Bruce, I just think I'll pass and sell it to somebody else. Having said that, however, I'm always in favor of that as a recourse, because unless you have rep and warrants insurance, which is expensive for smaller deals, but you can get it, or you're going to have a good size escrow to go against if something doesn't work, you really need a seller note. And when a seller says no, just emphatically no, there's got to be a reason why. Now, if he tells you, I'm 78 and I've been diagnosed with a severe illness, I get it. But if he's 61 years old and in good health and says no, that begs the question, why? Here's the other thing about a seller note. Most oftentimes, it's not going to be as good as the SBA financing, right? An SBA loan is a 10-year term loan, say prime plus 10.5%. So if you take that number and the seller says, yeah, I'll take $1 million note, but I want it at 8% over 5 years, that hurts your cash flow. So I would tell them, I would look at you and say, well, maybe decrease his amount. Let him get more chips off the table. Maybe he'll take a little bit discount in the price and get the rest from the SBA. I had one guy where he says, yeah, the seller's willing to hold $2 million. I says, tell him that you'll have him hold $750 and lower the price by $500. You both win. It's $1,250,000 swing, but he's going to get that much more at the closing table, right? He's going to get like $1.5 million. Just come back and use SBA because it increases the cash flow of the business instead of, so it's all in parts of negotiation, Jay. But I'll tell you that, I am not a fan of when a seller does not hold a note. I'm not a big fan of it because you just don't have, and I can share many, many stories of where thank God the seller held a note and my clients got him to hold a note where certain things happened. I'm happy to dive in deeper, but I want to make sure that I leave plenty of time for questions and ask.
Yeah. Guys,
I know, I can see it. Everybody's got a burning question like, oh my God, hurry up, Bruce, hurry up.
All right, guys, go ahead. I know you have questions.
So, this is Chandra. I've got one question. So what are your thoughts on a seller note that's, maybe it's 15% of the deal, 20% of the deal, but you do something like a 10-year AM with a balloon on the 60th month or something like that. Do you see any red flags there, or is that kind of a good structure to go after?
Yeah, it's Chandra, it's a great structure to go after. Especially from the bank side, and I'll tell you why. If the seller is willing to hold on a 10-year amortization with a 5-year balloon, he's 100% at risk. Because what happens is at the end of 5 years, what happens if you can't pay him?
Yeah.
Nothing.
Yeah.
Nothing. He can't take the business. He can't force you out of the business. The SBA is first. He's SOL. And he hopes that you can pay him. And that shows a lot of faith on his hat. I remember going into loan committee one time. I report exactly to the executive board. So I don't go up through normal credit channels, but I go right to the board. And we get into this conversation. One of our board members says, I don't understand why the seller would do that. And I went to him, who gives a darn? He wants to do it. What? Why are you even asking me? Why is 5 years from now? Who knows? We don't even know if we'll be on this planet the way we're going. I have no clue. And he goes, oh, that's a valid point, Bruce. Okay, done. Next question. So yeah, Chandra, if he'll do that, we love it. And if I'm you, I love it. It shows a lot of support for the business and a lot of faith in both you and the business.
What are the terms that you don't like, that you don't love, that you see?
He's holding a note for $1 million for 3 years. Because from an underwriting perspective, we don't think this is Lucky Charms that's going to magically appear. right? So we're going to amortize that and go, okay, can you save $333,000 and 33 cents, right? Over each of the next 3 years, because you're going to have to pay them. So in our underwriting, we underwrite it to that. That then makes the deal very difficult to pencil.
Got it. If it's amortized over 3 years as opposed to balloon or interest only.
We love interest only. You know, right now the SBA changed the rules where if the note is on full standby for 2 years, it counts towards the principal. So I just did a loan for that where the buyers put in 5%. The seller held another 5% on a 3-year. He did a 3-year standby and then amortized over the next 4 years. So it was a 7-year note. So great structure, but that counted towards the 5% equity.
Oh, okay.
And there was plenty of cash flow in the deal. So we did it at 90% financing because it was very well priced.
That's
so
awesome.
you can get in for as little as 5% down.
That's awesome. I'm going to ask you about the changes after. I know I saw a few more questions. Adam, you had a question?
Yeah, we're discussing about not having too big of a seller note. And what do you think is I guess the appropriate size to have them interested enough, but not, accelerating your debt payment too much?
Yeah. I had a conversation with the potential borrower this morning, and he modeled at 20% on a note and then 5% on a full standby. And I said to him, that's 25% of the deal. Are you sure he's going to accept that? Well, that's what I want to offer. I go, he's not going to accept that. And I went through, okay, you're asking him to hold 25%. He's got a broker. He's got the capital gains tax. I said, and you've got a working capital peg in there. The guy is not going to do the deal. Why would he do it? He's going to end up with sub 40% of the price. Not going to do it. It's not going to happen. So 10% is the normal. If you can get 15, great. But I'm all about, especially, having gone through this now over the last couple of years of buying businesses myself with my partners. You can always talk yourself out of a deal. On our last deal, we could have walked away 3 or 4 times. And now post, 4 months into the deal, we're all sitting around going, God, it was the best decision we ever made to not let this deal die. And we could literally, and Jay will tell you, every deal dies 2 or 3 times anyway, but we resurrected it. And I couldn't be more thrilled that we did, because we knew the seller did not really understand. It's a 45-year-old business that was handed down from the father to his son and daughter. They did a great job running the business, but they didn't know what they didn't know. And
what industry?
Distribution of police. We police equipment and guns and ammunition and all that kind of stuff. So super sustainable type business. But Adam, I can tell you there's a number of reasons that you can walk from a deal. But what I always tell people is if you walk, you don't get it.
Absolutely.
So there's certain points that you have to look at. What are the ones that you just absolutely can't live with? I just remember a friend of mine saying, I don't want to get married because I want to get married because I can't live without her, not because I can live with her. And I just remember that. And I kind of conveyed that to business. And I go, hey, that's pretty good. I like that.
Same. Nadal, you had a question?
Yeah. Hey, Bruce.
Hey, Nadal.
Hey, this is in relation to seller notes, and Jay and I actually had this discussion. Was it yesterday, Jay, or the day before? But anyway, this is about service-oriented businesses, no assets, just people.
Yep.
From all the deals that you have seen, right?
Yeah.
What is the range of a seller note? I mean, so obviously with pure service businesses, you want a bigger seller note because there are no assets in the business. If you could amortize it over 10 years, great. But what do you kind of see in the industry and just generally speaking?
So I would ask you, what's the difference between the seller note and the SBA note? They're both, obviously they're debt on both ends. Why is it more important for the seller note versus the SBA note?
Well, to the point you noted earlier is, they're kind of, if the business doesn't perform as well as it's built to perform. The seller is to a certain degree out of luck. I guess I would say as a buyer, I feel you have more protection. It's more kind of like from that perspective, kind of protecting your downside than anything
Risk
else.
mitigation.
Yeah. Risk mitigation.
I think to me, it's still an obligation, and it comes down to integrity and do you plan to pay it, right? And my intent would always be to pay it. In my mind, when you get really anything over 15% of a seller note, in my mind, you're risking the deal. I mean, if I'm a seller and somebody said you come in at 20% and this guy comes in at 10%, and we're talking about a $5 million business, right? That's meaningful. It's $500,000. I'm going to take his deal over yours.
Okay.
What does that look in professional services? Like, like in the business that he's talking about is it's like an inspection business where you're essentially labor arbitrage, or think about CPA or some, what does that look like in that kind of environment?
Same. I
Same.
mean, look at, here's the one thing I would say about that. If there's a key employee, like the seller is more absentee and he's relying on, I wish I was Paul. Look at Paul. He's out. Oh man, Paul, you're living it up here. I'm, stuck in an office. You look like you're in heaven over there.
Oh, by the way, Paul's also in Florida.
Oh, Paul's in Florida as well?
Oh, he's in Michigan right now. Okay.
Oh, I was going to say that does not.
Michigan now.
What part of Florida are you in, Paul? Because that doesn't look like the part of Florida I'm in.
Yeah, I'll be in Naples here. We live half the year in Florida, half the year in Michigan. So
very cool. Very
I have a few questions. Jay, am I next?
Yeah, go ahead.
I have a few questions. So I love Jay puts these together. A lot of us have sold companies, bought companies. This is what I do on a daily living. The first question I have is, if we're looking at leveraging a business acquisition based off the balance sheet of another business, how would that work? For some of us, we have multiple acquisitions, and that's something that's for roll-ups. If we have already and we want to acquire more, how is it just a matter of saying to the bank, I want to leverage the balance sheet of this business and then go from there? How does that work, Bruce?
Yeah, so you got a couple of things. If you buy a business with the same NAICS code, the same NAICS code, you can do that with no money down, because to the SBA, that's an expansion loan. So if you're using the balance sheet and you've got a NAICS, 1, 2, 3, 4, 5, 6, and you're buying another business and it's got 1, 2, 3, 4, 5, 6, you can really leverage it up. You don't have to put any money down.
We still have that limit of the 5 million, right?
Still have the limit of the 5 million. Yep.
Okay, so what do you do?
Essentially, because we do what we call pari passu lending. Are you
Okay.
familiar with that? Most people are familiar with that.
You can explain it. Yeah, you can explain it.
So pari passu just means, if you look up the definition, it means like kind in terms, right? So it's basically, it mirrors the SBA loan. It's a 10-year loan at the same rate. And we'll go up to 2.5 million over. So we'll actually roll up to 7.5 million in debt. So if you had a $9 million deal and you said, hey, we're putting in $1 million, the seller's putting in $1 million, we need a $7 million loan to do the deal, we'll do it. 5 SBA, 2 First Bank of the Lake. So that's what pari passu means. So Paul, from that standpoint, you can lever off the balance sheet. The other way you can do it is typically businesses don't lend other businesses money, right? But you would, because that's just not, on intercompany loans and all that kind of stuff. And if you're going to hold a hold co, you're just going to roll it and tuck it in under. But you can basically take distributions from your one company if you've got it, use that as your cash injection to buy another company if you want to do it. Great if it happens and it's synergistic and you can show, hey, here's a projection. But, with small businesses, you're going to have a third-party independent appraisal of the assets changing hand. So it's all going to be predicated upon the business that you're buying. If you're just buying assets, the business sucks, but you're just buying the assets of the business because you think you want to take it, then it's just an asset sale and you're going to do maybe an orderly liquidation valuation and you're going to get a loan to buy the business assets, not really as a going concern or entity. You're not going to pay for that.
So with some of the changes to the new SBA, I actually was told I was too liquid for SBA loans, but that I know that's changed drastically now. Is it also true that if it's another NAICS code up to 5 million, so you can actually have two up to 5 million if they're different NAICS code? Is that true?
I wouldn't say yes. I would say the SBA is looking at that very closely. They're looking at the changes that they instituted right now extremely closely. We do expect them to be rolling out or roll back some of those changes. So I think it'd be pretty hard pressed, Paul, to get a lender to do it. I'm just telling you, my personal and professional opinion, we wouldn't do it unless we got final clearance from the SBA. What people don't understand is, and SBA, it sounds like, which is great. The SBA has what they call the SOP, which is their standard operating procedures. Then you have the Federal Register, which has actually all the regulations. Those are different than the SOP. Mm-hmm. So when the SBA made the changes to the SOP, we as lenders went back to the SBA and said, okay, are you going to change the federal regulations? No. Okay, so when you go as a lender and if, God forbid, you have a loan that goes into default, that's why you're getting an SBA guarantee to protect, right? Yeah. They're going to come back and go, yeah, that's what the SBA SOP said, but here's what the reg said, right? Like it was with, oh, you can get an SBA loan and you can now roll equity. That was one of the big changes, right? But ask any SBA lender if they're going to allow a seller to roll equity without a personal guarantee. And the answer is going to be no. I've checked with them all. Everyone's like, no. Why? Because the federal regulations say you have to go back and drive down deep, peel back the onion. It requires the guarantee. That's why.
Yeah, this was a big debate for us in our group as well. Is this buying equity and letting the seller roll equity into the deal?
Yeah.
Did you have another question, Paul?
Yeah, one more. What questions should we be asking that we aren't?
In what regard?
Just, are there any questions of doing M&A that we haven't touched on here that, or maybe we haven't thought of to ask you in terms of finding lenders or just M&A or acquiring a business in general?
Finding lenders? Yeah, I love that. Thank you for asking. All right, I'm going to stop pounding my chest though. Yeah, I'm just warning. No. Look at, when it comes to acquiring a business, there's a lot of moving pieces. There are 1,000 SBA lenders out there. Some good, some not good. Everybody can't be great at what it is that they do. It just doesn't work that way, right? We all know people in organizations that got to a position that maybe they shouldn't have had just because maybe who they know versus what they know, right? I would tell you that, for example, I had a guy call me up this morning. He says, Bruce, I am not going to be able to get insurance. Is my deal dead? Now, a lot of SBA lenders might say, yeah, because you need life insurance in the amount of the loan. Well, I said to him, it's not going to stop you. I had the exact answer. I've done it. I know how to get around it, right? So what I would tell you, Paul, is just like the businesses that you're buying, do your due diligence. Ask the questions of the lender. You're going to find out very quickly whether the guy knows what he's doing or not. And does he have experience in this segment of the world? I started off with, this is all I do. If you call me up and say, hey, Bruce, I'm buying a franchise, I don't do that. Hey, Bruce, I'm expanding my business, other than if it's an acquisition expense, I don't do that. Hey, Bruce, I need a loan for working capital inventory, blah, blah, blah. I don't do that. I do one thing. There's a lot within SBA, but I only do one thing and one thing only, and I'm an expert at that. Why? Because that's all I do. Right. And eventually, if it's all you do, you become really good at what it is that you do. Right.
Like that.
And so I've got all the training and all the background. You want to talk about tax consequences. You want to talk about legal consequences. You want to talk about structuring an LOI. You want to talk any of it. I can talk with you. And I do it. So I sit in that seat. I have sat in that seat, and I continue to sit in that seat, and will continue to sit in that seat and this one. Right?
What do
And
you think?
so that's where I would tell you to do.
What do you think about opportunities of finding distressed? There are a lot of like search funds, and I think Chandra was talking to one recently. Chandra actually owns, I think he bought 6 so far, and he's coming across some of these traditional search fund acquisitions that are distressed right now, where they can't service their debt, and they're trying to figure out a way out. Is there an opportunity there for somebody who's a good operator, who's already got a platform within the same industry, to absorb an operation like that? How would you entangle that mess?
So SBA is a cash flow lender first and foremost. So you open up the SOP, it says you have to have 1 year's prior, historic debt service coverage, right? So buying a distressed business, and then you need a third-party independent business valuation. So if you're buying a distressed business, it's going to have a distressed price that goes with it.
Correct.
Right?
Yes.
So if you can buy it at that distressed price,
yeah,
and you can show that you're putting money in, that you're buying it at a good value, and you can make it synergistic, and you're going to make it look like this, then there is that opportunity. Yes.
But how do you do it when there is an SBA loan on it already? How do you kind of like entangle that situation?
Yeah. So I'll put it to you, I guess, appropriately, that the SBA does allow for assumptions, for loans to be assumed. So
Okay.
I have an SBA loan. Jay, you want to buy my business and assume the SBA loan? You can. However, the SBA is not going to release me as a guarantor.
Okay.
Because they already have me. Why would they let me go? Now, if I'm in real jeopardy of losing the business anyway, and I don't want to declare bankruptcy, and I have faith in you and I think you can turn it, maybe I would. Maybe it's a better play for me and say, yes, I'll allow you to assume it and I will stay on as a guarantor, because hopefully you're going to remove me from this burning bed.
Yeah.
And I think then that's the sell that Chandra and his team are going to have to do. You're in a dire situation, Mr. Seller. I'm going to come save you. I'm your knight in shining armor.
Yeah. Yeah.
Also,
No, it makes also there are investors in play. So I think that, go ahead, Chandra, you want to say something?
Yeah, no, that it's really interesting because they're in a similar NAICS code that we're in as our platform company, but I think he was a victim of his own ambition. Paid something like 6 turns. In addition to paying 6 turns, decided not to have a fixed rate, did variable rate. So when rates were at 5.5%, he was like, well, I think they're going to go down. So he essentially doubled his the rate of his loan in the last year, and also is growing the company. So didn't have enough working capital. So it got hit with a few different things at the same time, and now is looking for a rescue. And we're trying to see if something can work out with both of his, his board, and then also seeing what we can do from a refinance perspective. We hadn't considered assuming the debt. We'd only considered refinancing to a conventional loan to see if we can get it to work. But it's interesting to hear you could assume. So I didn't know that.
Yeah, and I would tell you the interest rate was less of a factor than the 6 turns in the working capital.
Yes.
Because that's going to burn up.
Oh, absolutely.
Right,
Absolutely.
Chandra? I mean, when you do an analysis, that's going to burn up way more than just what the increase in the interest rate was. Yeah. And that's, again, I always tell people, it's, if that noose is too tight around the neck, and I use that example all the time. I'll talk with folks and I'll say to them, hey, I'm going to mail you something. What? Rope. Why? Take it out back, put it around a tree and hang yourself, dude. you're structuring a deal that's, so tight that it's not going to work. Why would you do that? But again, like I said at the beginning, there's 99 reasons you can walk from a deal, and there's a couple why you wouldn't walk, and you have to just look at what's more important. But if a deal is too overpriced, you got to walk, because just the deal economics make you walk.
Have you seen have you seen enough distress out there in the search fund world? We're seeing, a lot of these search funders, we had people come and pitch their deals to raise capital, and then they're just too rich. They're just paying too much, and there's a lot of optimism in those projections. Have you seen any distress yet, or it's we're thinking it's going to be another couple of years?
Personally, no.
Yeah, no. Okay.
My portfolio is extremely clean.
Nice.
My clients are doing really, really well. But I look at it it's kind of like a self-fulfilled prophecy, because I have the power of the pen.
Yeah.
And I don't have to do a deal. And truthfully, Jay, the truth is I would be the first one to walk for a deal, not for me, but for you. I don't want to go to bed at night wondering, oh my God, did I do bad by this guy?
Yeah.
And in that example that I had tweeted about on Saturday, I walked basically at hello, because when he talked to me about the business and the business model and the sustainability, to me, that's first and foremost in anything, is the business model, the sustainability. Has it gone through some cycles? Has it weathered the storm? How do you de-risk it?
Yeah.
I look at cash flow third. But first and foremost is it the business model that I won't do, and I've tweeted about this a number of times, I don't do want businesses. I'm just not going to do it.
Nice.
I'm just not going to do a want type. I had a client call me up and said, hey, Bruce, I'm buying a great business. What do? It's an e-commerce business. They sell things. What do they sell? E-bikes. I'm like, e-bikes? Like, yeah, that's a want business. Nobody needs an e-bike.
Yeah.
Right? So I said, I'm out. I never got to the cash flow because I don't care. I'm not going to do that, because that's not a sustainable business in my mind. So I don't. So my portfolio is clean. I haven't seen any issues. I don't want to see any issues. I love it when people ask me, well, Bruce, tell me what it's like when a deal goes bad. And I love saying, I'm going to look you in the eyes and go, I don't know. And I don't want to know.
That's awesome. Drew, you had a question?
Yeah, I'll make it real quick. I apologize. My attention has been a little diverted back and forth, but my partners and I are looking at kind of an add-on or kind of a bolt-on type of acquisition that would be real similar to what we have right now, where I need to validate the NAICS code. But can you say one more time, like, what's the advantage of going after a business that has the same coding? There's lending advantages?
Yeah, you don't have to put in any money.
No kidding.
Zero down.
I thought that's what you said, but it sounded too good to be true. So I only heard it out of one ear. So
now the caveat on that, Drew, is that the SBA will let you be levered up to 9-to-1. 9-to-1.
You can be levered up to 9-to-1.
So let's say you had a business, and let's say that business, you look at the balance sheet and you've got $600,000 in equity on your balance sheet.
Okay.
All right. So you have your liabilities, and then you have, your assets, and then you have your liabilities, and then your equity, right? You've got $600,000 in equity on your balance sheet. You could borrow up to $5.4 million of SBA debt. Well, the maximum is 5, so you're there. Great.
Yep.
You do not have to put in any money down. I'll give you an example. I did a deal. I got the deal approved. The client never took it. I lost it to a conventional lender, but it was a CPA firm. A CPA firm sells for 1 to 1.25 times revenue. It's not on EBITDA. It's on revenue. So this business was doing about 3.2 in revenue and had EBITDA of like $1.7 million.
Okay.
So, it's like a two-turn. He was a CPA. He had the same exact NAICS code. He said to me, I'm buying this business. I said to him, you don't have to put any money down. And there's tons of cash flow. Let's go. 2 weeks later, I had an approval and he said, yeah, there was a conventional lender around here and the guy that is selling the business has a banking relationship and they want to do the deal. And they're giving me like
I got everything I need for
a 7.5% fixed rate. I'm like, good luck. I wish you all the best. You got to take it. You got to take it. And I lost it to a conventional lender, but it was that strong of a deal. But he didn't have to put any money.
That's beautiful. Thank you very much for that. I appreciate it.
Yeah, sure.
Any other questions?
Ask away. I'm free, so keep going.
Yeah. Hey, Bruce, thank you very much for that. I'm actually just bouncing because my question was literally about what you just said. Like, I know you might not be doing the conventional lending, but like how many times and which type of businesses do you see yourself like competing against, traditional lenders, mid-market lending? And then the last question would be, in your portfolio, I'm sure you have some allocation in terms of risk into different businesses. What are the ones that you like the best to have in your portfolio?
So I definitely lose, when you do bigger deals, better deals, stronger deals, the risk is that a conventional lender is going to step in. So I lost a really nice deal in Connecticut. And again, it was to the bank that was banking the seller. So if I'm a bank and I'm lending on a conventional basis to XYZ and now they're selling and this business is throwing off a couple of $1 million in EBITDA and I know the business and I'm a relationship manager, which I used to be when I first obviously started banking, why wouldn't I not try to go after that client? Right? And so the bigger, stronger deals, as they start to approach that $1.7 million, $1.8 million, $2 million in EBITDA, I generally will lose them to a PEG or a conventional lender. Does it make sense?
Yeah, absolutely.
The deals from a risk profile that I see that I love. My favorite is roofing. I'm doing 2 of them right now. Very, very large ones. One's a $13 million deal and the other one's a $12 million deal. Why? You come home at night, you and your wife walk through the door and there's drip, 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 drip. She's not looking at you going, don't worry about that, honey. It's fine. Right? Like your next day, you're putting the bucket there. You are calling the roofer and it doesn't matter how much it costs. If you can afford it, none of that matters. When can you get out here as soon as can and when can you fix it? And I've done a number of roofing companies and they all pay off early.
Oh,
So
wow.
I love roofing. I love it. I love contracting. I love HVAC. I love electrical. There's shortages you can't get help. The demand is off the charts. Getting quality that it's just, when I talk about sustainability, man, those kind of businesses ring with sustainability. So I love construction related businesses. Now, if somebody comes to me and says, hey, I'm a custom home builder, I'm selling my business to Joe Blow over here. No, that's not what I'm talking about. Right?
Or roofers that are heavy in new construction.
Correct. But again, it just depends upon where that market is, right? Like if you're here in South Florida and you're in Broward County, there's not really a lot of, you just can't find that space. There's just not a lot of it. But if you're in Texas, Texas is huge and it's growing. And you look at that market and you're going, I don't know if they're going to be able to house all these people. They're going to have to build housing. Are they going to have to change schools and auditoriums? All the other geopolitical stuff that goes along with it. But to your point, Jay, most likely, if it's new construction, it's going to be tough.
Bruce, I have a question for you regarding, you mentioned it earlier, there's 3 things you look at. Like the third one was cash flow. The first one was the need of the business. What was the second thing? Was it the balance sheet or something else not related to financials that you're looking at?
No, you, the borrower.
Oh,
What
the
you
borrower,
bring
okay.
to the table, your skill set. you have to ask the owner, because, you know, everybody hears, oh, the owner's 72 years old. He works in the business 15 hours a week. So this guy comes to me, he's in Texas, he's buying this business. Same story. Seller says, you know, I'm not that involved, blah, 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 blah. We get the loan approved, Paul. It's in closing. Talking with him, and I said to him, you really don't know what he does. He goes, Bruce, what do you mean? I go, have you done a ride along? Have you seen what he's done on a day-to-day basis? Have you spoken to any of his clients? No, okay. I go, dude, you have no clue. Right? And I talk like this because that's who I am. I am as real as you say I am. Dude, you don't know what you're doing. So he calls up the seller. He says, hey, my banker wants me to go through this before they close the loan. I said, blame me. I don't care. My wife blames me for everything. Dude, there's nothing you can blame me that I haven't been blamed for already 20 times over. He says, okay, he blames me. The guy does it too. Next day he calls me up. He goes, deal's off. He goes, you are absolutely right. When you're with somebody and that phone doesn't stop, that's a me business, man. That is a worst sign you can have. You want to be with the guy and the phone never rings. That's when you know he's not involved on a day-to-day basis. The guy says, I can't replace this guy, and I don't know what he knows, and he's imperative to the business. Bruce, I wish I had listened to you 2 months ago. I go, so didn't I. But for you, I'm glad. It's never worth a loan, especially if it's not going to work out, right? So first is sustainability, the business model, why they make business, why they make money, how they make money, why will they continue to make money, what's happening in the industry, what do I need to know, what's the role of the seller, what does he do, what skill set do I need that he has that I have to be successful in this business. All of that stuff, the cash flow doesn't matter, Paul, and I know you agree with that, if I don't have that. I always tell borrowers this, oh, the business did $3 million 2 years ago. Guess what? I don't give a shit. I don't care. I don't even look back then. Why? It only matters tomorrow when I lend you the money and what you can do with it when you buy it. It could be doing $3 million 2 years ago. If it's not going to do $1 million next year, I'm in trouble. You're in trouble. The seller's in trouble. The employees are in trouble. The landlord's in trouble. The suppliers are in trouble. The vendors are in trouble. The customers are in trouble. There's a lot of purse strings pulling in on that business. And I go down that very deep hole before I say yes, because all of that matters more than the cash flow.
Absolutely. And I had a situation where a husband and wife, same thing, spend a day with them. The husband spent the whole day with me telling me about all the duck hunting trips that he does every year. But the wife was running around the whole time, you know, putting out fires and taking calls, and she was with us barely for lunch, and that was it. So, you know, yes, they're playing the game that, hey, we're not needed here, but they are. You just didn't see. You have to keep watching what's going on. But Hisham, you had a question?
Hey, Bruce. Yeah, if I may, two more questions. One, you know, in the trade sometimes, and mostly in landscaping businesses, sometimes you see, you know, some of the salaries being paid in cash. The business still going to cash flow. It's going to have a great DSCR and whatnot. Do you lend to these type of businesses, or is just there was one shady area, red flag, move on? And yeah.
So you talking about landscaping in particular?
Yeah, I mean, that's just one example that comes to mind because there's a lot of labor that, you know.
You know, I'll just tell you, I am not a fan of landscaping businesses at all.
Oh, why?
I did one recently. I'll tell you why I did it. But 9 out of 10 times, I'm going to say no if somebody comes to me for a landscaping business. Why? Unless you know the corporate culture, live in that corporate culture, understand that corporate culture, speak the language, understand the value sets of your employees, it is extremely difficult to be successful. The other thing is I live in an adult community. We have a landscaping service. So we pay a monthly maintenance and we have a landscaping service. They suck. When their contract is up, I hope we get rid of them. Let's say you came in and you bought them. You have all these guys running around representing your business and you don't have any control of it. You don't, if you're not in the culture, you don't speak the language, understand how they operate. And being there and overseeing it, you're relying on your field managers to do that. These guys are like siestaing with these other guys. That's their crew. They're not looking to protect you. Trust me. So it is an extremely difficult business. Contracts can come, contracts can go. Are they tied to the association or they are tied to the management group? We have a management group here. They love this landscaping company. We fire the management group. The new management group comes in and says, we don't like them. We're going to bring in our own landscaping guys. I can go on and on and on and drill down into landscaping.
No,
Now,
that's
having
great.
said that, I just closed one. Why? The guy calls me up. He says, I'm blah, blah, blah. I go to him. I told you I'm transparent. I don't like landscaping. Can you let me finish? All right, I'll let you finish. He says, I already own 5 landscaping companies. Okay, I guess you have some experience in them. And I'm closing on one that I'm selling next week for $10 million. Okay, you've got plenty of post-closing liquidity, I gather. Yes, I'm buying one for 4.5. I'm going to use about $1 million of it. I want a $3.5 million loan. I'm going to use the other ones for other synergistic acquisitions. But okay, tell me where the business is. Fort Collins, I guess, Colorado. One of his existing companies is 2 miles down the road. This has a little bit different kind of clientele, so it's synergistic. So it's literally 2 miles down the road, just selling another business he had for 10 million. He's got plenty of money. He's putting in $1 million. He owns 5 already. I felt comfortable with that, right? So we did the deal. Other than that, I can't tell you the last time I made a loan to a landscape. I'm very hesitant because I did do one many, many, many years ago, and I'll never forget it because the guy was from Utah. He was a Mormon faith. He bought a business in Orlando, and in 4 months it went dark.
Oh, wow.
It went in 4 months. And that's what we call an early payment default. And the SBA comes in and says, not sure we're going to give you your guarantee. That was a painful lesson. I was a young man doing it, but I learned. And it's kind of like when you get burnt with fire, you don't want to go near it.
Yes.
But I took the time afterwards to find out the mistakes that I made and learn about it. And if you look like me, and I told you, I'm just very transparent and straight. I don't speak a word of Spanish. I could not buy a landscaping business. It would not work out well, no matter what. Just wouldn't.
Yeah.
I don't mean to offend anybody, but it's just
no. It makes complete sense. We talk about this all the time. I know Chandra has a question, but I want to say something before. How do people work with you? Do you like to meet with them pre-LOI, post-LOI? Do you like to pre-qualify them, not pre-qualify? How one works with you?
So as you can see, I'm shy and I don't like to talk. So having said that, right? Look, this is all about you, right? So I love when people get me in early. I share stories of this one guy bought a roofing company. He was in the roofing business. He called me up. He said, Bruce, I got your name, blah, blah, blah. He said, I have not the slightest clue what to do. I have a lot of experience. I've saved some money. I've got a deal. It's not on market. It's a friend of mine. He's selling his business. I want to buy it. what do I do? I says, well, we have to start with an LOI. He said, what is that? Literally, what is that? And I walked him through and we closed the deal and it worked out phenomenal. So I use that example because hopefully you're the client and I'm here to service you. So whenever you want me to jump in, that's when I jump in. If you want me to jump in LOI afterwards, beforehand, hey, Bruce, I've got a sim. I've got some interest. I don't know much about the industry. Want to get your feelings? Give me your take. Can you look at it? Can we talk about it? Absolutely. So hopefully, Jay, you'll share my contact information or my numbers with everybody.
Yeah.
If you're not following me on X/Twitter, I would ask you to, not for me. I don't care whatever, but every Saturday I post War Stories Saturday. They're stories that I have had people, it's very inspiring for me. I've had people call me or DM me and say, Bruce, you don't know me. I got an SBA loan. It was well below your bucket, but you have helped me tremendously. And to me, that's just incredible feedback. So my handle is at SBA Marks. And every Saturday I post War Story Saturday, and Jay, you've seen a number of them and can share.
Yeah, I posted in our feed, we have a WhatsApp feed, and I posted the last one you did, which was great, which kind of inspired some of the questions. I'm assuming you felt it. But I'm gonna go to Chandra. Before I go to Chandra, what do you think about the government, the government construction type businesses, which Chandra is in, like the businesses that
Government contracting business.
Yes,
The government contracting space.
Yes.
Love it. Love it. We understand that there's a concentration risk, Chandra. You know, I'm very familiar. I've done a number of deals in the government contracting space. We're fine with it. You know, there's some certifications. We love lending to veterans, anybody in that space. So we're going to support government contracting and those that serve. So yeah, love it.
Cool. Yeah. So our customers are typically the ones getting grants. So our companies put in fiber optic cable into the ground. So it's underground construction. And then we've got a couple of electrical contractors as well.
Love it. Love it.
My question is around the assumed loan that we talked about a little bit earlier. So if we assume a loan, an SBA loan, does that go to the $5 million cap, or can we assume one and then use that $5 million to acquire a competitor?
So if it's a loan, it's already on their balance sheet. You're just assuming it. So you're not getting any cash. You're not getting any money. You just assume you'd buy the company and you get the loan. And whatever the balance is whatever the balance is. Let's say it's $2 million. You can borrow up to $3 million more. You can come back and go, hey, I want another SBA loan for $3 million, $4 million, $5 million. Depends, because you know, if you're working with a lender that does pari pursue. So that's an option for you. Does that help answer your question?
Yes, it does. I'll probably bug you after this. I'll shoot you an email.
So you mentioned two things. You mentioned customer concentration. How do you think through client concentration?
So I love giving examples because everybody likes stories, right? And I was in LA all last week learning how to become a better storyteller. So, so I had a client, and I always use the word client, but it doesn't mean that they're actually my client, but I just say it. So it's just out there. So I had a potential client. I remember it was in the New Orleans area, and he called me up and he said, Bruce, I'm buying a manufacturing business, and the top 4 clients represent 85% of the business. Wow. And the other 2 represent the other 15%. They've got 6 clients.
Wow.
And that's what I said. Wow. He said, but it's extremely sticky and I want to share with you why. So he said, we went through the deal. They manufactured a product where you had to have a specific mold to manufacture the product. The molds were made for the companies. So for those companies to leave, it practically would be impossible because they'd have to have another whole mold made. The company was giving great pricing. I asked, okay, is the seller involved? He has nothing to, they don't, at this point, they don't even, because it's one customer had been a customer for 22 years. They don't even, the clients have changed hands a couple of times. The buyers changed. They don't even know who the owner is. Perfect. We're okay with that. Although it's customer concentration, there's specific reasons why it's going to stay.
It's captured.
I lost that deal to a conventional lender, by the way.
Wow.
The lender who was financing that business already got the deal. I lost the deal to a conventional lender. But that's a case when we look at customer concentration and you look under the hood and go, why? What are the attributes that they're not going to move? Why is there customer concentration? Not that just there is, but why?
Yes. Yeah.
And the reasons make a valid yes or no, right? For both of us. A lot of times when I'm speaking with potential clients, we're doing this together. This isn't you against me. It's you and I against the seller per se. How do we de-risk it and make sure that it's a good transaction? Jay, I always talk about this. You get up from the table and one guy goes, hey, high five, I won. That's never a good deal. You know that.
Yeah,
right?
Absolutely.
It's got to be everybody getting up from that table, shaking hands and going, this was a good deal. It was a good deal for the buyer. It was a good deal for the seller. It was a good deal for the bank. It was a good deal for the intermediaries or the brokers involved in the transaction.
Yeah, it's more sustainable.
That's when it's a good deal and you know it's going to work.
Yeah. Do you guys finance everywhere in the country, all 50 states, or just?
Yeah, of course. And we did a deal in Alaska. So,
sweet.
Yeah, we closed the deal in Alaska last year. Not I did. It wasn't my deal, but another loan officer here at the bank closed the deal in Alaska.
So in contracting and in construction businesses, how do you think through the license? Let's say Adam is a doctor and he wants to buy a roofing company in Boca Raton. He doesn't have a license. How does he do that?
Yeah, so I don't lend to doctors because they're lousy business people. Now, having said that, sorry,
good.
Adam, are you a doctor?
He is.
Okay. Don't be buying a roofing business, Adam. But I have closed a number of transactions. Let me share a story with you because it's really a cool story. I did post it on Twitter, but I left out a main ingredient because I was concerned about what the audience might look like. But I had a gentleman from Wharton. He and his partner, Barry was in Texas. Maurice was in the West Palm Beach area. They signed a contract to buy an electrical contracting company in Orlando. And they had owned businesses together and they wanted to buy this, but they didn't have the electrical contracting license. And they were concerned that I wouldn't lend them the money. And I said to them, okay, how do you de-risk that? Well, the seller is going to stay on. Well, we're going to tie the seller note to that. Like if he doesn't stay on, and he doesn't help you with the transition, and he doesn't perform the duties that you're going to request of him, but he's going to hold a bigger note in that situation, right? It's not going to be 5%. It's not going to be 10%. It's going to be 15% because the license just can't. Okay, how many other master electricians are on board as well? And do you have, and are there enough in the area? Because a lot of times what happens, you can buy those licenses, right? As you well know, Jay, you can hire somebody, they can come in, they step in, you pay them $2,500 a month, they hang their license, right?
Yeah.
We went through all those scenarios. And so we did the deal. And I talked about that on the Twitter. What was very interesting in this particular deal was Maurice and Barry, and I'll capitalize the B, were both Black. They were buying a business where 95% of the workforce was like us, white American males, whatever.
Yeah.
He was very concerned how they would perceive him coming in to buy this business. So he called me up and he said, Bruce, I know you owned a consulting company for 13 years. I want to talk to you about what thought process you have for integration into the business. And I said to him, here's exactly what you're going to do. The seller is going to bring everybody into the conference room and they're going to post your resume, no picture. They're going to then put a slide up with your schooling, your background, what you've done. The third slide is going to be the businesses you've owned, what you've done with them, how successful they are. Now you start to paint the picture of who you are, what you bring to the table. The fourth slide is going to be what your vision is for the company and what you think that their roles will be in helping you going forward. And after he does all that, then you'll walk into the room and he'll introduce you, because now they're going to already have in the mind a painted picture of you, not the color of your skin. He was concerned about.
Yeah. And how you going to make their life better? How you going to improve
All those things, right?
everybody's situation? Yes.
And it worked out beautifully, and it's worked out well. And he's
So you go to tie the owner with some higher seller financing just long enough for them to find someone else to rent the license from or get their own license at some point.
exactly.
Okay, makes sense. Okay, Hisham, you had a question?
Oh, sorry.
I hope
Yes.
we're not holding you up too long. I appreciate you taking the time and staying longer. I know the guys, everybody thought this would be an interesting conversation for sure. We're gonna end up going a little bit longer, but you tell us whenever you want to end this.
I'm
So
good.
we
I'm
appreciate
good. I'm just
appreciate
chilling.
it.
I wish I had a glass of wine by me. So
Well, you can go grab one.
Next time we'll do it at 7 p.m.
And Adam,
we're
I
all
don't
gonna
want you to
go
think
get
bad
a
of me, Adam, because I
margarita.
said you're a doctor and I don't think you can run a business, but I don't know. Are you going to go buy a clinic? And you look young, so.
What were you
Well,
looking at buying?
to be determined. What's that?
He was looking at what was the business that you're looking at?
So recently, I'm actually talking to. It's actually a franchise, but it is a medical clinic that does. It actually does some like primary care, so it does accept insurance. And they've actually gotten insurance to cover like IV therapies and stuff like that. So it does like hormone replacement, the IVs, primary care, the like peptides.
That would make sense, right? Right. You're staying in your lane. You're
Yeah.
buying something that you're going to bring value to. You're going to bring something that you can, know about, right? And a lot of times those clinics, like we'll get a lot, well, like these, there's a word for it. I'm not sure what it is, but these clinics are run, but the doctors aren't the owners.
Yeah.
They come in,
Yeah.
they buy the businesses and they hire the doctors and those kind of things, right? Like,
Yeah.
but it's always interesting in that model. Hey, I'm a business owner. I'm a great business guy, but I'm not a doctor, but I want to own a medical clinic, right?
Yeah.
Yeah.
And there's a franchise out that shows them how to do that. And, the doctors that they can hire, but the doctors have you over the barrel, so to speak, right? If you lose one, you can't get one. What do? Put closed temporarily? I mean, just, while you try to find a new doctor.
Yeah, I mean, I think their model is typically to have like a PA or nurse practitioners and stuff like that. So I wouldn't probably be the one providing the care, but I would be the supervising like physician for them. So they actually offer a passive model. I don't know if I'm looking for that, but I would probably keep I'm an anesthesiologist, so I would probably be like more semi-active in it, I guess.
Cool. But it's like that makes sense, right? You're staying in your lane. You're not buying
Okay.
a roofing company, as Jay said.
All right.
Hey, Bruce, I just had a question. Like a lot of the time, not a lot of the time, but I do come across these where there's two owners. One wants to retire earlier than the other one. The other one wants to stay another 5 to 10 years.
Yep.
I usually try not to keep the owners or the owner like more than 3 to 5 months, but in this case it could be it's a manufacturing, it's a little more complicated, so it's not bad to have someone with that business acumen. And he's owned the firm. Now if I do an SBA loan, like because he's going to be a 50% owner, does he have to be on the SBA loan as a guarantor?
Mhm.
Yeah. Okay. And then what do you think of these? Like, is there a preference or not, or you're agnostic?
Agnostic.
Okay. Thank you.
Is there a way to structure it where you keep? So number one, I didn't think that you can have the owners stay on an equity to get an
He can if
SBA.
he wants to guarantee.
Okay, so as long as he wants to guarantee, then you can stay on the SBA.
Now you can. Now you
Got
can.
Now you can.
The
Okay.
original, we talk about it, and
Yeah.
it's interesting. I'm kind of a dinosaur because when I originally got into SBA lending and got trained, I literally went to the SBA district office and got trained by the SBA. I'm a dinosaur.
Nice.
But having gone through that experience, I can tell you that I understand why a lot of the rules are the rules, because I understand how the SBA's thought process was, because I hung with those SBA people. I got trained by those SBA peoples. The thought behind the new changes in the SOP was this. I own a pizza restaurant. Jay, you've been working for me for 5 years as my manager. I don't pay you a ton of money, so you don't have a ton of money. But I want to retire now and I want to sell the business to you. That was the premise of this.
Makes sense.
Not the search fund space.
Yeah.
Right?
Yeah.
The premise is, okay, I'll transition the business over to you. I'll let you, buy into the equity. I'll keep a small chunk for the down payment, and you go get an SBA loan. I take 90% of my chips off the table. That really was the premise of it.
Yeah. So it's set up that way.
Yeah, but it's not. It just didn't turn out that way. That was the intent, and in the SBA, that is the key word: intent. Believe me. That's why they used to have, people used to always say, I don't understand. It doesn't make sense why the SBA would only let a seller stay on for 12 months. The intent was, you are buying the business. This is your business. You still own part of the business, Jay. I come to you and I go, yeah, I know Andrew said to do it this way, but you know what, Jay? I like doing it your way. And Andrew goes, but Bruce, I'm the new owner. Yeah, but you know what? I like the way Jay does it. I'm not going to do it your way, Andrew. Right?
Yeah.
So there was always, and you look at SBA from an intent standpoint, and that's what it goes back to.
Do you work with these investor groups like similar to Acquira and, SIG and all these guys? Do you ever work with them?
I do a fair amount of business with SIG.
Okay.
Mainly because when Robert started his business and he bought Pilgrim Health 4.5 years ago, Robert Graham, I was his lender. Then when Jordan Carter bought his business, I was his lender. I'm the one that actually introduced those two.
Nice. Okay. So you're familiar with their operation. You're familiar with their form. Okay. How about Acquira? Did you ever work with Acquira?
I recently had a call with those folks because they reached out, but I can't say I've done a deal with them yet.
Got it. What do you thought about that model? What are your thoughts? How do you think about that model from the investor side?
Explain it to me a little bit deeper and I'll tell you. I'm not 100% from, I know of them. And like I said, I had an initial call, but don't really understand.
Somebody having been around, do you think that's a model that's sustainable long term? Do you think that the return?
What model?
What return on the syndicating, the subsidizing the down payment for an SBA debt for an operator, and then returning capital, having some control, because a lot of these operators, they tend to keep control through covenants of when
you have to in an SBA loan. Again, control is a big issue with SBA.
Correct.
So the searcher has got to be the guy that has control.
Correct. But if you look at the model, there are some covenants in some agreements where they can have some control, where they can force a sale or
that won't fly with SBA.
Really? Okay.
That won't fly with SBA. Maybe that's why they don't do it, or maybe they change up enough of their agreements with the ones that they do where they give the guy. They ask for the operating agreement, but they don't ask for the shareholder agreement. So
yes,
it could be a little bit different.
Yes.
Yeah.
So long term, what do you think of that model? In general, it doesn't matter who it is.
Yeah, no, it's fine. I mean, I'm fine with the model. I'm fine.
Yeah.
with it. Yeah.
Okay. Okay. And okay. And then in your term, my final question, you said that you're buying stuff right now. Do you do it as a syndication, JV?
I have
What are
three or
you looking
four.
for?
I have 3 or 4 partners. We find the business. We look for the searcher. We put the searcher in place,
Oh,
and
nice.
we own sub 20% because we're not going to personally guarantee. But it's 18% of this business, 18% of that business, 18% of this business.
So you're doing a traditional model stuff, or are you doing the same?
I would say
like
we're
SIG
probably
model?
more like a
The SIG
hybrid
model.
between, more high with an independent sponsor type of model.
Yeah.
I would say is how we probably more look. We get an SBA loan. The searcher is the guy that takes the SBA loan. He guarantees the debt. He's on the hook. We're below the 20%, but we've got a decent stake in the business.
And you put in the full down
The equity.
payment?
We put in the equity. Yep.
You put in the equity. Okay.
Yep.
And then what are you looking for? And if we find an operator for you or who has a deal, what are you looking for? What does that look like? Who do we send you?
As an operator?
Yeah, or an operator with a deal combo.
So, for me, it always starts with the deal and the business model, the sustainability, finding the right business. And then I love the searchers who have come out of the military. So I've got a preference if the person's got a military background.
Nice.
I want them to have, a very good MBA degree, from Harvard, Wharton, Kellogg, Stanford, Booth, Rice, that kind of thing. I want that. And 10 years business experience. Because generally what happens is we're giving them the opportunity, hey, you're going to get 30 to 40% of this company. We've got to be synergistically aligned to grow this business. We're happy to give you that. But you're the guy in the seat. You're the guy making the decisions. You're the guy that we're relying on. You got to put some money in, but you're signing a $5 million SBA guarantee. So
yeah.
Okay. So the economics, they keep 30%. You guys have 70%, and then do they earn that 30%?
No. Generally they get it. Now they could have tag along rights, or they can have, a step up in basis if we want to give them bonuses and things of that nature for doing a great job. But I'm fine with a little of a lot.
Okay. And the goal is to exit in 5 years?
Pardon? Yeah, typically like a private equity, 5 years, and then we're looking to exit.
Awesome. Okay. Well, I appreciate you taking the time, Bruce. Thank you very much.
Of course.
We'll put your contact information, and we'll send. You're probably gonna hear from our guys. So just remember, if you hear Go Abundance, that's us.
Okay. Awesome. Thank you again. And if you ever want to do it again, just let me know. Happy to jump on.
I will. Thank you.
Do it again. Okay.
Sure. And where are you in Florida?
The Fort Lauderdale area. Broward
Okay.
County.
I'm moving out there. I'm in Hawaii, so it's like 10 o'clock my time.
Wow.
So I'm moving out. I'll be there at the end of the month. So
you moving? Wait, what part?
Boca.
Oh, well, so I'm in Parkland, which is the last street before
I'm looking
Boca.
in Parkland.
Hi?
I actually have an offer on a house in the country club, the Parkland Country Club.
You're about 5 minutes from me.
Which community are you in?
It's called Four Seasons. So you're off of that's Coral Ridge Drive. Well, depending, it's between University and Coral Ridge.
Yeah.
Right. So you're moving to Parkland Golf and Country, right?
Yes.
Yeah. So I'm off of Coral Ridge to the end, make a left on Lockahazee, and I'm right there.
That's awesome. Oh, we have to connect soon. So
yeah, you'll be my neighbor. We'll grab lunch.
Yes, for sure. I appreciate it. Thank you.
All right, Jay. Sounds great. All right, buddy.
Thank you.
Thanks.
Bye-bye.
Bye.